Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, November 29th, 2017. We actually had a very large amount of inflows come into the conventional fund business. I'll talk about the conventional fund business first, and then go to ETFs later on. Basically, about $30.1 billion entered the conventional fund business coffers. That's a really big number. And the headline numbers are a little bit misleading because really most of that's money market. We'll get into detail in a second. But that was the fourth consecutive week that we've seen inflows, and really over the last several weeks, it really has been a money market story. Even though we had Thanksgiving Day, obviously everybody had off, and Friday early close, we actually had some really good numbers. We had a record set as far as the S&P 500, the Dow, and the NASDAQ. They hit all records on Friday, even though it closed at 1 o'clock. And basically investors were hearing some good news on pre-holiday sales and holiday sales, and obviously they got some good news on Friday as well that Black Friday was going to be a success. As well, especially online. There were some good numbers that came in before that. But I think what really sent people off for the week and actually gave them kind of a good feeling as far as returns go is the Senate Budget Committee basically came out in a 12-1 or 12-11 vote that basically said, yes, they're going to put the new tax proposal ahead to the Senate to vote on. And that kind of piqued investors' interest. Basically, again, we had record closes, but we had a little dour piece right at the very end of the fund flows week, again, ending Wednesday. On Tuesday and Wednesday, we had some concerns happen. We had North Korea test another missile again, and this one was a little bit more threatening, got a little bit higher than people thought, saying that they could possibly reach D.C. There was some concerns there, but basically investors kind of blew that off and said, hey, listen, it looks like the Budget Committee is putting that tax reform plan forward. And then we had some disconcerting news on Wednesday. We saw some of the three big players in the tech side of the industry, you call them the mega caps, if you will, Amazon and the like. Those actually had a meltdown. So we had a tech meltdown on Wednesday, but it really did not impact the markets all that much. We saw NASDAQ actually end up for the week with negative returns, but we saw the Dow and the S&P 500 certainly in positive returns. Again, the tech-heavy indices took a little bit of hit, not too bad. Let's see how this news actually panned out into the fund flows and taking a look at our macro groups. Equity funds actually saw about, and this is where I was saying, a little bit of lopsided, $3.2 billion in outflows, conventional fund business again. Taxable bond funds only took in about $141 million, and muni bond funds only took in $39 million. So it really wasn't a good story in those three fronts. And then we take a look at money market funds, and they saw $33.1 billion come into those coffers. And it's really interesting that we're seeing new highs in the NASDAQ, the Dow, even the Russell saw new highs this past week. And then we're seeing investors put money to work in money market funds. I think they're thinking that the market is a little too rich, a little too dear, and they're deciding to sit on the sidelines just in case we have a meltdown. Certainly they're going to wait to see if the Congress can push through that tax reform budget, and certainly earnings news has been great. So again, they're waiting for the government to do what they're supposed to be doing. Let's go ahead and take a look at the individual breakouts one by one and give you more detail. Let's take a look at equity funds now. They had a return of about 0.53%, which was very strong. Fourth week in 5 that they've seen positive returns and pretty good numbers if you look to the right. It's really been kind of a strong couple of weeks that we've seen. But again, this time for the 36th consecutive week, we've seen outflows. $3.2 billion flew out of the conventional fund business on the equity side in there. And how that broke out, if we take a look at domestic equity funds saw outflows of $3.1 billion. It's the 48th consecutive week they've seen outflows, although they had a 0.93% return for the fund flows week. So kind of a head scratcher. Then we take a look at non-domestic equity funds, and for the first week in 8, they've seen outflows, but only to the tune of $128 million. They had a return of 0.19% loss. So that was kind of the story there. Large cap funds lost about $2.1 billion, and global equity funds saw the other outflows, about $309 million. So that was kind of the major trends that we saw. International actually took in a little bit of money. Now let's go ahead and turn our attention back to the ETF universe that I was talking about earlier. For the 9th consecutive week, they saw inflows, $5.7 billion this week. And at the top of the universe was basically the iShares Edge MSCI USA Momentum factor ETF. So about $829 million come into their coffers. iShares Edge MSCI minimum volatility fund, so about $807 million. And if we go to the bottom of the barrel, we saw the Spider Dow Jones Industrial Average, that's DIA, lose about 371. That's a little bit of head scratcher because it really actually saw a record close again on the very last day on Wednesday. So it had 2 or 3 different record closes that week. And then we also saw PowerShares QQQ, for obvious reasons, take a hit as well, down about $323 million. So not a lot leaving their coffers either, but certainly a tale of two cities there. ETF investors, authorized participants, putting money to work. The conventional fund business, the equity funds, taking money out and just staying away from the equity markets on that side. Let's go ahead and turn our attention to fixed income funds now. And fixed income funds for the second consecutive week saw inflows, but this time only to the tune of $141 million, as I said earlier. Second consecutive week, they've seen net new money come to that group, and they had a positive return of 0.07%. The big gainer, if you want to call it that, corporate investment grade debt funds, so about $440 million come into that group. 26th consecutive week they've taken in money, and international global bond funds took in 138. Fifth consecutive week they've seen net new money come into that group. Corporate high yield bond funds basically saw the only outflows out of the group, $292 million. And actually that's not true. We saw another group that took it, but it's the mixed asset group in the balanced funds category, lose about $141 million. So really, when we're taking a look at the fixed income side of the universe, things are still on the positive side. People a little bit concerned after Powell started to he actually had a congressional meeting where he testified before Congress as his appointment as replacement to the Fed chair. And so I think people are getting a little bit cautious because he is going to keep on, if you will, that hawkish stance. And so that was a little bit concern on the conventional fund side. Let's look at what happened on the fixed income side as well of ETFs. Take a look there. We saw that they saw about $1.4 billion in inflows. Second consecutive week, they've taken in net new money. And at the top of the group, we saw iShares, iBox, High Yield, Dollar, corporate investment grade debt funds, corporate high yield corporate funds take in about $323 million. And then the next group was the iShares Intermediate Credit Bond ETF, taking about $214. Not a lot to talk about there. iShares 10 to 20 year bond fund actually saw one of the biggest losses, and that was only $95 million. So again, it looks like the authorized participant, while taking a little bit more risk on, we're still keeping the pedal to the metal in the fixed income universe. Let's go ahead and take a look at muni bond funds now, and that's one of the areas that we've kept an eye on. Fourth consecutive week that taken in net new money, and this is to the tune of only $39 million. Again, very low. Third consecutive week that they've seen negative returns, though, and this one a whopping number of 0.52% loss. And again, when you get a 1 week return of 0.52% as losses go, that's a pretty big number, some concern. However, where we saw high yield muni bond funds actually took in money, $72 million, and this is the fourth consecutive week they've seen money come into their group. Let's go ahead now and close the session by taking a look at money market funds. And money market funds, again, saw some big numbers. Fourth consecutive week, $33.1 billion. Took a look, 16 out of the last 22 weeks, they've taken in money. And so we can only assume that most of this is probably being done by institutional accounts. Now, when I say that, 401ks, 403bs, retirement accounts that are being set up by firms are considered institutional in nature, and we're thinking that the folks approaching retirement age or already in retirement are actually becoming a little conservative. About 8 3/4 years into this bull market, it's been a grand bull market. I think people are really becoming hesitant and really have kind of tasted what can happen when they saw the dot-com blow up and they also saw the financial crisis, that they're willing to sit on the sidelines until we can either have some resolve from the Senate and the Congress, the Senate and the House, Congress passing the bill and getting that going, because really we've had some pretty fair returns as far as equity goes. But what we saw is $33.1 billion in inflows. Taxable money market funds took in about 33.3, and here's where we get the breakout. Institutional investors accounted for $35 billion of that. So obviously retail investors were net redeemers at $1.8 billion. If we take a look at the tax exempt side, they lost about $154 million this week. Not a lot to talk about. Well, that's it for me, but I did want to say that we saw some interesting news yesterday, and kind of followed through today. Basically, we saw October personal income come in higher than expected, about 0.4%. I think analyst expectations were 0.3%, so that was good news. And then we heard news that Q3 GDP had been revised up again to 3.3%, and prior number was about 3.0%. So really some good news, and we'll have to see how that follows through. Again, people are concerned about some of the geopolitical concerns, and certainly keep an eye on Congress to see what they're doing as far as the tax plan goes. But as we enter the holiday seasons, I think people are going to be looking for Santa Claus rallies and the like, and maybe a continuation on at least through the year end. If I haven't done a deep enough dive for you on the Fund Flow site, you can go to our Fund Flow site at www.lipperusfundflows.com, or you can join us next week where one of our analysts will talk about the flow trends of the week. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.